The semiconductor value chain, 4 high-growth stocks winning without making a single chip. The Union Budget 2026-27 has signaled a strategic shift with the launch of India Semiconductor Mission ISM 2.0, backed by a 1,000 Indian rupees crore allocation to move beyond assembly into high-value design and materials. Industry estimates suggest India's semiconductor market could reach 100 to 110 billion by 2030 as demand rises across sectors. Chips are part of almost everything we use today. They go into phones, laptops, cars and network equipment. As digital use grows, demand for semiconductors also rises. If India builds more of this ecosystem at home, it can support local manufacturing and cut import dependence. The government has cleared large projects and is offering incentives to draw global and domestic players. Businesses that supply materials, engineering services, or infrastructure to electronics makers can also gain. When manufacturing activity rises, these linked companies often see steady demand as well. As India builds up its supply chain, these adjacent companies could see faster growth. In this context, we have selected 4 stocks that are not direct chip makers. Instead, they are positioned to benefit from the expanding semiconductor and electronics ecosystem. Their products or services are used in materials, infrastructure, engineering, and industrial segments that grow as semiconductor activity rises. This makes them hidden but relevant beneficiaries of the larger semiconductor cycle. 1. Navin Fluorine International, the specialty chemical backbone of chip materials. Navin Fluorine International is primarily engaged in producing refrigeration gases, inorganic fluorides, specialty organofluorines, and offers contract research and manufacturing services. Its portfolio includes 50-plus fluorine-added compounds developed over the years. Chemical catalysts, the specialty foundation of fabs. Navin Fluorine posted a sharp rise in earnings for the December quarter. Revenue in Q3 FY26 stood at 892 rupees crore, up 47% from a year ago. Net profit rose 122% to 185 rupees crore. For the 9-month period, revenue increased 44% to 2,376 rupees crore and margins improved to 32%. Management said capex projects are progressing as planned. The Chem Hours project is expected to be completed in Q1 FY27. The company is also exploring opportunities in electronic chemicals linked to the semiconductor value chain. While input costs remain a factor, order visibility across segments remains steady. Semiconductor fabrication requires high-purity specialty chemicals and fluorine-added compounds at various stages of production. As chip manufacturing capacity expands, demand for advanced chemical inputs could rise. 2. SRF, leveraging fluorochemicals for the tech supply chain. Incorporated in 1970, SRF manufactures and sells technical textiles, chemicals, packaging films, aluminium foils, and other polymers. SRF reported modest revenue growth but stronger profit in the December quarter. Gross operating revenue for Q3 FY26 rose 6% to 3,713 rupees crore. Net profit increased 60% to 433 rupees crore. The improvement came mainly from the chemicals business. Revenue from the chemicals segment grew 22% to 1,825 rupees crore. The fluorochemicals division saw better realizations as global refrigerant prices remained firm. Supply discipline in China also supported pricing during the quarter. Engineering the ecosystem, designing the chips of tomorrow. SRF is expanding capacity in next-generation refrigerant gases at its Odisha facility. The first phase involves an investment of 1,500 to 2,000 rupees crore. The company is also adding a second pharma intermediate plant to reduce dependence on agrochemicals. Pricing pressure continues in specialty chemicals due to competition from China. Management indicated that demand remains stable, but margins will depend on global trends and raw material movements. 3K Industries, powering the semiconductor infrastructure build-out. Incorporated in 1968, K Industries manufactures wires and cables W&C like EHV cables, HT cables, LT cables, and sells them in India and overseas. K Industries posted steady growth in the first 9 months of FY26. Revenue rose 21% YoY to 82,714 million rupees. Net profit increased 35% to 6,341 million rupees. The improvement came from better volumes and tighter cost control. Powering the infrastructure, the role of advanced cabling. During the period, the company began commercial production at its new Sanand plant in Gujarat. The first phase was commissioned in December 2025. This facility will expand capacity in low and high tension cables. K is also working to grow its extra high voltage cable business. Exports formed 17% of total revenue, compared with 13% a year ago. The company now serves more than 60 countries and operates overseas offices in select markets. Management indicated that demand from power and infrastructure projects remains stable. However, profitability will continue to depend on copper and aluminium price trends. Semiconductor fabs and electronics plants are power-intensive facilities. They require extensive cabling and electrical infrastructure. As manufacturing facilities and data centers expand, cable demand may rise alongside broader electronics capex, which may benefit companies like K Industries. For L&T Technology Services, the engineering brains behind chip design. L&T Technology Services (LTTS) is an engineering services provider incorporated in 2012, offers engineering, research and development (ER&D) and digitalization solutions to companies in the areas such as transportation, industrial products, telecom and high-tech, medical devices and plant engineering. L&T Technology Services reported revenue of 2,924 rupees crore for the December quarter, up 10.2% YoY. Net profit stood at 329 rupees crore for the period. The company said better project mix and operating discipline supported margins. Large deal wins during the quarter were valued at 180 million. The sustainability segment grew 11.4% YoY, driven by demand in industrial and plant engineering. Mobility showed some recovery after a soft period. Management said it has exited select low-margin assignments as part of a broader strategy review. For FY26, the company is guiding for mid-single-digit growth. It expects margins to improve gradually as higher-value projects scale up. Disclaimer: this article provides stock market news for informational purposes only and should not be construed as investment advice. Readers are encouraged